afternoon, everyone, and thank you for taking the time to join EDC's webcast version of the Spring 2016 Let's Talk Exports Tour. My name is Carolyn Ely. I'm a Media Relations Officer for EDC, and I will be your moderator for today's webcast. For any of you that are new to the Let's Talk Exports Tour, or to EDC, you might not realize that we have an in-house economics team. This team conducts analysis about anything to do with Canadian trade, from our Country Risk Quarterly, where the team provides insight into the risks and opportunities of over 100 countries, to our weekly commodity tracker, which gives Canadian businesses up-to-date knowledge about the changes in commodities that are most important to them. You can find more from this team in the Knowledge Center section of our website after the webcast. Today, we'd like to share with you some insights from one of the team's most popular reports, the Global Export Forecast. This semi-annual forecast takes a look at economic trends from across Canada, in every province and every territory. One special piece of the forecast is that it is presented to us by EDC Chief Economist Peter Hall. Every spring, Peter does a cross-Canada tour where he presents his summary of the forecast and meets with Canadian businesses of all sizes to answer their most pressing economic questions. Peter is here with me today, and this marks the last stop in his countrywide tour. Peter, you must be exhausted. How does it feel to have finished another successful Let's Talk Exports tour?
Well, Carolyn, I'm actually energized by the tour. I like nothing better than to be out there with our customer base and to be talking with them, to be sharing the insights that we see on the global economy, the effects on the Canadian economy, effects on their province and their particular area of business, and to hear what they have to say about what's going on with them, to compare notes with them, to find out what it is that's going on, and to bring that intelligence back into the building.
This webcast is really about you, our participants. While Peter is employed by us at EDC, he's really working for you, the Canadian exporter. We want to make sure that we help you take advantage of this time. Throughout this webcast, we'll send out 3 poll questions so that Peter can tailor the information he shares to fit your interests. All responses are completely anonymous and will be used to better understand how we can provide you with the best knowledge to suit your business. You can also use the Q&A button on your screen at any time to ask Peter something specific. We will have a formal Q&A session at the end of the webcast. We also say it every time, but do your best to stump Peter. No one has been successful yet, have they?
Oh, I'm sure I could think of questions that would stump me. So there are questions out there. We just want to challenge everybody to, tell us what is it that's on your mind, and I'll do my level best to answer those questions.
All right, well, let's get started. I'll kick us off. Peter, we're seeing some really unusual things happening in the global economy right now. It seems like we can't shake the volatility and chaos. This year, we've already seen commodities continuing to drop. Oil especially has had a significant impact on our dollar. The Bric Nations that everyone was expecting to pull the global economy into growth have been faltering. Now we're hearing about another Greek bailout. There's still potential for a Brexit. This just seems like a risky world for any business owner. What do you make of all this?
Well, it is. There's a lot of negative news circling around the globe. It hasn't stopped. It almost seems like we've had 7 or 8 years of this kind of news. The difficulty with the more recent news is that since the middle of 2014, we've seen an enormous tumble in a lot of different indicators out there. People in Canada are very familiar with commodity price drops because we are a commodity economy. But bond markets have been in turmoil, currencies have been bouncing around all over the planet, and we've also seen a recent tumble in stock markets. Now, what happened to us? We came to our desks on January 4th after all of this plunge, and we got a replunge. Talk about a happy new year. We switched our screens on, and what did we find? We found the Chinese stock market shut down. And in the ensuing period, the next few days, it shut down another couple of times. So this was extra turmoil on top of turmoil. So we all entered the year, if we weren't worried enough about things, there was an additional wave of uncertainty that came from all of this turbulence as well. And so when we went out on the road, that's where we started the whole message off. I mean, we know that everybody is hit with the messages that are coming through the media night after night about all the negatives that are out there. And that just adds to all the things that came into the economy, the structural weaknesses that appeared way back when the recession occurred. So it is a market mayhem type situation, and Canadian businesses are operating inside of that environment.
Yeah, it sounds like it's a pretty daunting economic situation overall, like you said, with the bond markets and stock markets, and I'm sure all of our participants are really looking forward to hearing more.
Well,
we're just about to send out our first poll.
Okay.
And we're going to ask the audience, what market are you most interested in for your next exports? Once we have the results, then maybe we can talk most about the most popular market chosen. In the meantime, why don't you, Peter, tell us a bit more about what the market indicators are really saying and what your team is looking at in this forecast?
Well, that's a really interesting question. That's almost the key question that we have to answer before anything. As I've gone across the country, these market indicators really are responding to the situation in a very unusual way. Normally, when we see an economy that is gaining strength, and everybody's been expecting the world economy to gain strength, this has been the thing that everybody has been waiting for. When is the growth cycle actually going to take off? Well, there is evidence of growth out there. However, the indicators are moving in the opposite direction. Some of those are actually leading indicators. And when a forward-looking indicator is pointing downward, well, that's when everybody starts to pay attention in a really big way and get really nervous about what's going to happen over the next 6-month period of time. And so when stock markets are going down, stock market indices are actually a part of country composite leading indicators. They actually throw it into a bucket of indicators that are showing where the economy is going to be going over the next few months. So when something like that is going down, that's not very encouraging at all. Let's also go to the commodities space. When copper prices are going down, and they've tumbled at a double-digit pace since that magic mid-2014 period, when they're going down, well, we gave that little red metal a PhD in economics because it was so good at projecting where the economy was going to go. So when it's tumbling, everybody pays attention and says, okay, well, this looks like a really wobbly world. Layer on top of that a plunge in oil prices. Well, most people know that when an economy is growing, we're using more of that stuff. We're driving more energy intensive. Businesses are getting all fired up, and you've actually got some upward pressure coming out of that. So when we don't just get a plunge, but we get a replunge in those prices, when the economy looks like it's supposed to be growing, that's very troubling. Last thing I will say, steel prices. Okay, so iron ore has been tumbling, metallurgical coal, because steel prices have not been great. There's been a glut of steel out there. Well, we know that when an economy is growing, we're building more cars. We're putting up more structural steel. We're building more houses. These are all steel-intensive exercises out there. So when those prices are tumbling as well, everybody stands back from that and says, okay, this does not look like a growing world. This looks like something where, I've got to actually be pulling back or at least sitting on the sidelines because I'm not sure what's going on out there.
Interesting. So we've just finished our first poll of our audience, where we asked, what market are you most interested in for your next exports? And I think this plays really well with what you were just talking about, Peter. The results are that the majority of people are most interested in the United States. And based on your team's research, we know that that's not surprising. That's generally where Canadian exporters look for their first export. Let's talk about the U.S. You've said before that you think the U.S. consumer will drive global growth. I think that's what you're hinting at. Is that still the case?
Well, here's where the growth story begins. The U.S. economy is the engine of the world economy. In spite of what was said over this, post-recession period when alternates were being put in its place, we never sort of backed away from that story, the American economy is the most developed, the most technologically advanced economy in the world, the one that has superior productivity growth. So if anything is going to drive things forward, it is this U.S. economy. The fact that it happens to be our #1 customer, together with the growth that we're already experiencing in this market, makes it, no mystery that that's the #1 concern of our viewers. And so here goes. The U.S. consumer is strong on a multiple of fronts. First of all, they've had 67 consecutive months of very strong employment growth. We're going to get another number tomorrow morning, and we're expecting to see strong growth out of that as well. What that's done is a second thing. It's driven their unemployment rate down to the 5% level. That's usually a crisis point or a critical point, let's say, because labor market pressures are really starting to emerge. The third thing I would say is those labor market pressures have actually kicked up real wages. So strong job growth, a tight labor market, wages starting to rise. Are you beginning to get the picture of a U.S. consumer that's got a little money in their pocket for the first time in a long while? Well, layer on top of that the fact that American consumers have done a lot to deal with their debts over this intervening period of time. They got an almighty shock back in 2008 with their levels of indebtedness. So they've done a substantial amount of deleveraging. Now, if those aren't convincing enough arguments, one more thing. Lower gas prices get passed on in the U.S. far more quickly than they do anywhere else on our planet. And so what that did was to give American consumers a $110 billion bonus just for nothing, just for being there. They didn't drive any less. They saved on the gasoline expenses that they had. So that represents 1.1% of their entire consumption bucket. Like that's a 1.1% boost on growth in 1 year. That's tremendous. Sometimes that's all the growth we get in a year. And so this is huge. The American consumer is 70% of their economy. Somewhere between 11 and 12 cents of every dollar that circulates worldwide starts right here. So with that kind of strength and with the potential strength that is facing them going forward, we're feeling pretty good about the engine economy of the world.
So it sounds like a great growth story. Are Canadian exporters actually benefiting from this strength in the U.S., though?
Absolutely they are.
Yeah.
I mean, as I was going across the country, company after company was telling me, you know what, the story that you're telling is absolutely right. We're seeing growth rates that aren't just 3-4% at annual rates. We're seeing, 10, 20, in some cases 30% growth in their export orders. And they've got big smiles on their faces across the country. Now, I understand it's not the energy sector that's feeling that way. It's not the mining sector that's feeling that way. But double-digit growth is happening in areas like machinery and equipment exports, like the auto sector, like aerospace, consumer goods. These are all areas that we're seeing very, very strong activity in. So to date, this year, the real export activity is rising. It's rising at a very strong rate, and that was corroborated by the exporters that we talked with in the 11 cities that we covered.
That must be nice to hear sort of it from the customer as well. So let's switch gears here a little bit. I'm sure we'll get back to the U.S., but we're going to also send the audience our next poll question, and this time it's specific to the Bric Nations. Peter, not long ago, you were calling the BRICS the great story for the world economy, but now we're seeing all kinds of challenges from the Bric Nations. I'm interested to know, is there still a growth story there? Let's look to Brazil, for example. We have the Olympics coming up very shortly, and in the meantime, the whole world is watching the economic and political situation with bated breath. Tell us your thoughts on this BRIC leader.
Well, Brazil is definitely going through challenges at the moment. Let me put it this way. You can be an economy in a thriving world, and the growth is happening all around you, and you're not participating in it. Why is that the case? Well, think about it in a business sense. If you're a business and you've unfortunately made some strategic decisions that aren't quite on the money or are actually going the opposite direction of where everything else is going, well, you get cut out of the growth. It doesn't mean the growth isn't happening. but you're not participating in it. And unfortunately, in Brazil's case, growth is happening around the world. The engine economies are getting fired up. It's not just the US, actually. Europe is getting fired up as well. And so the twin engines actually driving the world economy are seeing this growth swirling around. But in Brazil's case, if you don't have an infrastructure that can actually accommodate the flows of the goods and services that the world needs and even that your own economy needs, then I'm afraid, you know, the arteries are going to clog up and the blood is just not going to flow. And that's the difficulty inside of Brazil. Something radical needs to happen in order to break through that. Well, the difficulty is most of that is construction. And the construction industry in Brazil has almost gone into lockdown because of the corruption scandal that is swirling around at the moment. So, you know, that together with the displacement of a leader, that's causing Brazil to actually have a situation that's not actually a recession. It's looking more like a depression. And we believe that that situation will work itself out. And when it does, boy, there's going to be a lot of growth. Patient capital is already going into that market. That's because that patient capital knows that at some point in time, these problems are going to be resolved. And at that moment, Brazil is going to see some pretty impressive growth.
Okay, so potentially a good story in Brazil. We'll see sort of how that plays out. What about number 2 in our BRIC nations, Russia? That's a tumultuous story, isn't it?
Sure is. You know, Russia's story has sort of the same flavor as the Brazil story, as far as we can see. You know, growth again can be happening all around you, but you know, get involved in a very contentious and divisive war that the rest of the world doesn't agree with. Sanctions go up. Well, you're de facto going to be cut out of key lucrative growth that is happening elsewhere in the world. So, you know, again, if you don't have open borders for one reason or the other, well, it just so happens that things are going to be bad. Now, complicating the situation inside of Russia, of course, is the plunge in oil prices. That's a very oil-dependent economy. So that couldn't have happened at a worse time. And Russia's performance is actually very, very similar in a decline rate sense to what we're seeing in Brazil. So again, another economy in depression. 2 out of the BRIC nations feeling that way doesn't make the world feel like it's actually on a solid footing. But I want to re-emphasize that the growth is happening elsewhere, and unfortunately these 2 very important emerging markets are missing out on a lot of the action.
Okay, so not much growth story in Russia.
Although there is a potential growth story inside of Russia. I need to emphasize that as well. You know, once sanctions are over with, you know, no leader is going to be able to, you know, withstand those kinds of drops inside of an economy forever. So, you know, we're actually looking to a moment when Russia reopens.
Yeah.
And at that point, boy, you know, they've been holding themselves back for a while. And just like in the Brazilian case, you know, the potential there for that is very strong.
Well, and I think that you make a good point. That will also help with companies who maybe have supply chains through Russia as well, right?
Absolutely.
So the BRIC nations, we got the results from our last poll, asking if any of our participants are considering one of the BRIC nations, so some of the developing nations in the world, for their future business. And the results are that, yes, they are thinking about exporting. The majority of people are thinking about exporting to one of the BRICS within the next 2 years, or they are currently exporting to the BRICS. Mm-hmm. So that's Brazil, Russia, India, and China. Why don't you talk to us a little bit more about China now? Yeah. At the beginning of this year, like you said in your intro, the Chinese stock market took a large plunge. Overall, it's been a very bumpy year for this country, and everyone was seeing it as a big growth story. What can we expect in the future? Is this still a strong market for exporters, or should they be weary?
You know, it's amazing how quickly things can turn on everybody's darling market, and how quickly people can start at least making comments like they're running for the exits. It's amazing how quickly we can dot back and forth. I think in China's case, it's really important to put it in perspective. So I'm going to dial back quite a number of years. China built itself. You know, it had a 35-year run of growth that was spectacular, and that's when everybody was talking about the Chinese miracle and how quickly they had moved themselves into the new millennium. You know, a very, very impressive story. But that was built on international trade. And when international trade was in its excessive period at the end of a very long 16-year growth cycle, you know, there was 5 to 7 years of excessive activity in the world economy. And if you're a trading nation, you're participating in that excessive activity. So was China. That actually pushed up trade as a share of GDP in China to just below 70%. Well, along came the Great Recession. You know, that excessive activity couldn't go on forever. The Great Recession comes along to purge some of that out. And in 2 years, China's trade to GDP ratio went from just under 70% to below 50%. Well, that was a huge crisis for an economy that had only known growth for a very long period of time. So what do? Well, you go into panic mode. And while the rest of the world economy was stimulating to the tune of somewhere around 4% of GDP, China came out with this policy that was worth 13% of GDP. Then they added monetary stimulus to that and knocked it up even more. So nobody saw anything quite like what China was doing out there. And it was because China had a really big hole in its economy to fill. Well, maybe the second modern miracle that China's come up with is that they've been able to stimulate that economy over a 7-year period of time and generate some pretty impressive GDP growth numbers and keep themselves going. You're keeping 1.3 billion people fed. You're keeping all of your employees engaged inside of firms. Are you going to create excesses? You're going to create some bubbles inside of that economy. You're going to create financial bubbles. You're going to create bubbles in real estate, in terms of industrial capability, infrastructure capacity, and so forth. And so that's what China's faced with at the moment. And when the bank comes along, whether it's a Chinese bank or another bank or any kind of financial institution, and says, you're not sure that you're viable at the moment, that's a pretty big issue. So how do we put that in perspective? Well, China is China. It is a 1.3 billion person economy, and that sets it apart from just about everywhere else, because when you can leverage the power of that kind of consumption, let's say, in an economy, and their government is trying to do that at the moment, well, that's pretty big heft, not just for the Chinese economy, but for the economy in the rest of the world. So how do we put some numbers to this? Well, most people don't know it, but the average Chinese householder saves 40% of their paycheck. Now, I'm not going to ask our audience in a poll to tell us how much they save. I actually know the answer to that because I see the aggregate statistics here in Canada.
I want to tell you how much
No, that's right. We don't want to admit what it is that we're doing. But, the truth of the matter is when you're saving that much, that represents a huge amount of potential spending inside of the economy, because you have all of the savings that you have racked up over the years together with the fact that if you dial down your savings rate from your current paycheck, you don't have to do that very much before you can actually knock up the rate of growth inside of your economy quite substantially. So let's just say that the average Chinese person decided they were going to lower their savings rate by 2% a year. They could do that for 10 years and still have an extraordinarily high savings rate. You know what that does for the economy? It boosts the rate of GDP growth, of consumption growth every year by 3.6%. Now, in a good year, that's all we'll get. And so that's the bonus they get on top of the growth they're already generating. So they can do that for a substantial period of time. And that goes to bottom line GDP. That knocks it up by 1.6% a year. Well, if you can invoke some kind of policy that actually encourages that kind of activity, you're not putting the savings in jeopardy, and you're generating a whole lot of year after year growth in this very powerful economy. So people are worried about 6 to 6.5% growth, and I've just made a case for knocking that up to somewhere between 7.5% and 8% growth. And really, it is quite achievable inside of that economy. If that's the case, and China does have all this growth potential, then I'm far less worried about them being able to soak up the bubbles and the imbalances that they have inside of their economy. That kind of growth is the kind of growth that can much more easily sop up those kinds of excesses.
Okay, so there are some really interesting, there are some negatives, but there are some really interesting positives in China. There's a potential for a growth story. There's, lots, it sounds like there's still some opportunity there. There's one BRIC story we haven't talked about yet, and that's India. Is this a BRIC story we can put in the good news column? What are the opportunities there for Canadian exporters?
Well, I'm sure our audience sees the widening smile on my face when you mention India, because India, as far as we can see, is really the China of the next long growth cycle. And the reason that we say that is really threefold. What we're seeing is that there are an enormous number of Indian people, 600 million at last count, that still earn an income that's dependent on agricultural methods that date back to the 18th or 19th century. Things are pretty backward there. That doesn't sound like a good news story, but more and more of those people are aware of what's available in the rest of the world and are very eager to participate in some of the wealth. That's the aspirational element of the Indian economy. It is an economy that's on the move, that wants to grow, and where many millions of people are looking for new opportunities. Secondly, I would say that what's enabling that is a vast increase in the infrastructure and the abilities or the capabilities of that infrastructure inside of India. And I could go on at great length about what they've done to date. Some people say it's not nearly sufficient, but every new piece of infrastructure opens up opportunities inside of the economy that unleash these aspirations. And the third thing that I would say is, in a world where the population is aging almost everywhere else, India is becoming a place where manufacturers can look to say, well, there is a huge population there that's largely untapped. Could they become the world's key workforce in the next growth cycle? Could investment actually be pouring into India because other countries, China included, don't actually have the population capacity to drive their economies forward? So this would be a thing that would be very good for the Indian economy, very good for the economy in the rest of the world, and we believe that these are the kinds of things that are kicking the rate of growth inside of India now to a rate that's exceeding China's rate. India is consistently punching above 7%, while China is drifting into the 6 to 6.5% zone. So India is really starting to show those stripes at the moment and showing a lot of growth potential at this point.
Okay, so a lot of growth potential in India. Does that mean that you would recommend that Canadian exporters look there as their next export destination?
I would say that to not have India inside of a Canadian exporting strategy that is focusing on emerging markets would be to leave one of the key gems in the world economy out of the story. Absolutely, at least think about what could be done with the Indian marketplace. We are already observing, in terms of our own business volumes here at EDC, quite substantial growth in the business that we are processing in India. So that is giving us a very strong sense that Canadian businesses are going into India in greater numbers and with larger deals. And so this, we believe, may be the near end of some very, very exciting activity between Canada and India.
That's great. So India is our good news story.
Yeah, it is.
That's good. So we're about to send out our last poll question, and this time it's about commodity prices. This has been on everyone's radar for a couple of years now. While we wait for the results, let's talk about the dollar. Would you say the Canadian dollar has stabilized? And what does all this change mean for Canadian businesses?
Well, that's a great question. I mean, if I could predict the Canadian dollar with 100% accuracy, I would be doing this webinar from some exotic beach in the world somewhere. That's not the case, but we do have a model that incorporates 5 factors, and that has guided us through this period of time actually quite well. And so let me share that with you. Commodity prices really account for the first 2 factors in our model. So we segment out energy prices, and then we take all other prices. And so clearly what's happening in terms of the volatility of commodity prices, that's making our currency volatile as well. We also incorporate short-term interest rates between ourselves and the United States. That's a very key driver of our currency. So as America is looking at tightening up interest rates and Canada is on hold, and we believe that Canada will be on hold until at least late 2017, well, the opening up of that wedge between our interest rates is actually suppressing the level of our currency. We believe that that has already been priced into the currency, and so the low levels that we see at the moment are a result of that. So put that together with the final two elements. The first is, we're on the back end of the U.S. currency, and if it's doing something versus all currencies, well, we participate in that as well. And then the final element is, you remember when the recession occurred, Canada had very solid banks, very solid fiscal policy. We had the resources that the rest of the world needed, and we also had a very strong domestic economy. Well, those things have all started to fade. So put all of that together inside of the current context, you see those drivers, and if they're fluctuating a lot at the moment, well, the Canadian dollar is going to fluctuate as well. Our average forecast for this year is 75 cents US, rising to 77 cents US next year. But you know as well as I do that we've been as low as 68 cents US this year, and we've bumped up to 80 cents. And I can't guarantee you that things are not going to be volatile, because that's what's happening with this retraction of liquidity in the marketplace. That is actually causing the volatility. It's a very uncertain environment. So I can't give you a point estimate of where it's going to be month by month. I can give you an average and say that's what the fundamentals are pointing toward. But I believe that in this marketplace, you really need to be prepared for fluctuations.
Interesting. So the dollar has not stabilized, is what you're saying?
No, it hasn't. That's the short answer to the question.
Okay, so we received all of our poll responses, and it looks like the majority of our viewers actually feel like they are not impacted by the change in commodity prices. I think we've all been affected by commodity prices directly or not, but at this point they change so much that maybe it's even hard to tell. Let's talk about the country's biggest commodity, oil. We were seeing a lot of troubled times in the oil fields all year, last year. EDC even earmarked $750 million in financing to support SMEs that are in the oil fields to help them through this difficult time. And then we faced another blow, the fires in Fort McMurray. How does the turbulence in oil really affect your dollar forecast?
Well, it is a key driver. As I said, it is really the first driver that we look at in our currency. Our model will say that a $10 movement in oil prices will change our currency by roughly 3 cents US. And so it's got a very powerful impact on what we're seeing out there. So, most people then want to know, well, what's our oil price forecast? What's driving that as we go forward? That's an equally difficult one to get a handle on. And what I will say is, we did not expect that oil would plunge to the levels that it descended to over the last 18 to 20 months. So the depth came as a bit of a shock to us, but the direction did not. We actually foresaw that a growing world economy would actually suppress these prices. So we're looking at an average of about $40 this year now in terms of West Texas Intermediate crude, rising about $5 next year. And you all know that the price has actually risen above that at this point in time. Well, there's another indicator that I don't really trust as well, because the difficulty is that the market has faced is that there was a tremendous amount of speculation on oil that happened over this past 7-year period of time. And so that market is one that's actually trying to figure out what equilibrium is at this point. So again, here's one that we expect to see fluctuate over the next little while. But in general, what we do expect to see, and I actually wrote about this earlier this year when oil was plumbing some of those awful depths that led key forecasters to say, ooh, maybe $20 oil is what we can expect for the next 4 or 5 years. We didn't buy into that. We just saw that this was a period of particularly extreme turbulence and short selling, and we believed that there would be a recovery from that. So we're very happy to see that that has actually happened, but we would caution Canadian exporters that, that is going to be a wild one. Now, last thing I'll say about that is, there are two sides to the oil story. They're the oil users and they're the oil producers. And there's almost a direct transfer between one and the other. The producers are getting hit, and it's a very difficult period of time where there's a lot of rationalization going on. But for users, there's actually a fair amount of stimulus that's going on. And this is something that's not just true for Canada, but for around the world. And so we can't take our eyes off the fact that lower oil prices are actually freeing up money all over the world for people to use for other things.
Okay, so throughout this your talk, Peter, you've made a convincing argument that Canada is capitalizing on all this volatility and mayhem. I have to admit, though, for me, I'm wondering, is this sustainable? You say that there's volatility, and then you see strength, and I'm struggling with this, but I'm not an economist. So can you tell me about these two contradictory things and why you think they go so well together?
Well, it's a great question to ask because most of our listeners aren't economists either, and so it's highly confusing for everybody out there, and I've got great sympathy for that. Most of the time, as I'd said before, that you see these two things happening, one of them is going to suffer versus the other. Either it's going to fix the growth is going to fix the volatility, or the volatility is a sign that the growth is going to disappear pretty soon. So, which of the two is it actually going to be? Well, it's going to be neither this time around. The growth and the volatility actually rarely are sort of the twin sisters of this economic growth cycle that we see. And what do I mean by that? Well, growth is actually the thing that kicked off the volatility. See, there's all this liquidity that was out there in the marketplace. The liquidity flooded into the marketplace, and it came into the marketplace at a time when very few people actually needed it. It was there to convince people that they actually had access to their funds, but they didn't actually need them for real activity. What do I mean by that? Well, you remember when the recession occurred, consumers, particularly in the United States, were overly indebted, and they went into deleveraging. We can talk about loans to them, and they would say, I'm not in the loans game anymore. I'm actually running away from that. You go to the average business, and they would say, well, the recession has given me, way more excess capacity than I can handle at the moment, so I'm not exactly in expansion mode. So here's all this money out there with nowhere to go. So where did it actually go? Well, many had to take those funds and say, well, we've got the funds, we've got to earn a return on those. So if we can't do that by actually investing in regular things or by lending that money out to the consumer base, we've got to park that money somewhere. We've got to find an instrument where we can get a yield on that. Well, there was lots of money inside of the bond market flooding it out. And you know how that works. When there's more money chasing bonds, it drives the price of the bond up and it drives the yield down. And essentially, bonds right out to the 30-year spectrum were driven down in terms of yields. There was no more yield left, really, that would compensate people for tying up their money there. So where did the money go? Well, it was pushed out onto the periphery of the market into things like stock markets, particularly emerging market stock markets. It went into bond markets, the high-yielding ones, in emerging markets and also, in the corporate world. It went into currencies, things like carry trade plays, and it also went into commodities. Well, when we saw it go into commodities, we thought, wow, this is really dangerous because the money is going into commodities. It's boosting the price of commodities, but inventories are high and rising, and usage rates are going down. So this isn't really supportable by any stretch of the imagination. So what happens then? Well, when you have wave after wave of quantitative easing, it just sort of perpetuates this. The moment of change is when you actually have to withdraw this liquidity from the marketplace. You have to do that, and all of a sudden the lights go on, and it's like, wow, we've been parking this money in these instruments. We've been keeping them artificially high. Now we need access to that money. And at the same time, central banks are saying there's way too much money out there. We've got to sort of ring fence this money so it doesn't cause inflation. The money starts to come out. Where does it come out from? All those instruments it was parked in. And so at the same time as you see growth initiating in the economy, you see a downdraft in all of these indicators. So maybe for the first time in human history, we see these indicators going in opposite directions, and it makes perfect sense.
Okay, so all these indicators going in opposite directions, but it makes sense.
I hope it makes sense.
It does. I think that I'm becoming convinced.
Good.
But what's your advice for the Canadian exporter then? If this volatility does mean growth, how can they protect themselves while still remaining in this volatile world?
That's an excellent question as well. We're not any help to anybody if we just say, well, this is the environment, so have fun, enjoy the ride. What we're wanting to make absolutely sure of, that if there is growth potential out there, that as many Canadian exporters get access to that growth as physically possible. So if there's a growth story and that growth story is not making it to the media, the negative stories are swirling all around, there's lots of people around the world that are running away from the economic picture because they're afraid of the volatility. If I'm telling you there's actually growth out there, and by the way, businesses across Canada in all these cities that we have traveled in, as I've already said, have been telling me growth stories. 10% growth stories, 20% growth stories, even 30% in some cases. Some are doubling their sales to particular markets. This is the kind of activity we're in. And they're wearing big smiles on their faces, but they're also concerned. They're concerned about this volatility because they're worried that this great story that they're experiencing at the moment is all about to evaporate. What I'm saying is the fundamentals suggest that that is absolutely not the case. This growth isn't going to evaporate. So what's the strategic prerogative for Canadian exporters? It's to go for the growth, and then it's to manage the volatility, to manage the risks that are actually out there in the marketplace. And this is EDC actually counseling you along these lines. We actually sell insurance products, and one of our most popular products is accounts receivable insurance. And what that does is, that's a policy that you can take out that will ensure that inside of this mayhem market that we see, you're actually going to get paid. So in the middle of this, many are saying, well, the house is on fire. And we're saying, well, we're not quite convinced the house is on fire. Many people are, but we're actually willing to sell you a policy at such a moment to make sure that you will be whole inside of an environment like this. That's just a taste of what we can do.
Thank you, Peter. And while that does sound like a shameless plug for EDC, it's true. We are here to support our Canadian exporters. So now the moment that you've all been waiting for, the Q&A session. Our audience has already sent in some questions. We're going to give you a chance to send in a few more. So if you haven't already, press the Q&A button on your screen to ask Peter any questions related to the forecast or economics. We might not get to all of them, but we will do our best. And while we wait for the last couple of questions, I have a very pressing question for you, Peter, and one that I understand was the most popular question on the tour this year. What will happen to Canada's relationship with the United States should we see a President Trump elected?
Well, let's start with an easy question here. Actually, you're absolutely right. This was the most oft-asked question out there on the road, and it is obviously something that is highly concerning for Canadian exporters. When you have, a presidential candidate who's gaining momentum, talking about building protectionist walls around the #1 economy in the world, that's a huge concern. And regardless of who actually gets in, what is happening with that rhetoric is it's catching. So other candidates are using the same sort of language, talking about building some kind of fortress America as being the way of taking America forward. Well, that causes us to blanch and to say, well, where is the future of international trade? What kinds of changes, alterations to our strategy should we be making? And we're talking about our #1 customer by far here. So, all I've done is to make people more worried about all of this. Well, I think that what we can say about this is we have seen this kind of protectionist rhetoric before. All we have to do is rewind back to 2008. And it wasn't just the United States at that time. The whole world community, some of the greatest beneficiaries of globalization were almost the first to stand up and say, we're going to start building walls around our economy. So China, with its huge stimulus program, wanted to keep as much of that inside of the economy as possible. And so they started talking about a China first policy. But they weren't the first. France was out there saying, if you're going to let go of any employees, French multinationals, you're going to do it at installations outside of the country. And it had, globalization aficionados sort of scratching their heads and saying, that doesn't make sense because, they don't make over there what they make over here. If you let somebody go over there at that part of the supply chain, you're going to have to let somebody go inside of the economy. And so it was amazing how quickly some of those pronouncements were actually retracted. They ended up being rhetoric that did not turn into reality. Well, most frightening for us at that time was the Buy American strategy, and that was the same sort of thing. But the initial policy that was announced was very different from what was actually implemented, and I believe it's because of this. You can imagine a pronouncement, and instantly the CEOs of major multinationals in the United States are phoning up the president or somebody close to him and saying, look it, we don't make that stuff here. We make it in other economies of the world, and we ship it back to ourselves. That's how we pass on low prices to the average American. And whether you're talking about an Apple iPod, or whether you're talking about a New Balance shoe, or whether you're talking about Caterpillar making equipment, or, just think of the huge multinationals in the US phoning up and saying, get it. Like the way that global supply chains work, well, they need free and fluid borders. Or you start laying off people at home. And that's exactly the opposite of what these pronouncements are meant to do. And so, talking about building either physical or notional walls around the most globalized economy in the world, I think is a rhetoric that is, once again, not going to turn into reality. And, there's a little bit of finger crossing that I'm doing around that for sure, because I can't really imagine a world and what it looks like if those walls actually go up. It makes everybody worse off. So we don't think it's actually going to see the light of day.
Well, and especially with you saying the U.S. consumer is driving so much growth, that would make it extremely difficult. I think that's promising. So we're going to go with the positive.
All right.
So now to one of our first questions.
Sure.
We've had a few questions about your thoughts on Africa as an export market. I know that's a big place. If you can maybe get a little specific and tell us a little bit about what you see for Canadian exporters there.
There are a couple of different markets, and so we should be clear what it is that we're talking about. The North African markets are very different from the Sub-Saharan African markets. And so, again, what we see is a play that has become a bit more of a longer-term play. Folks who are doing business there know very well that commodity price plunges are not good for the economy itself. You have one economy after the other that are very dependent on commodities, whether they're agricultural commodities, whether it happens to be oil and gas, whether it's the mining sector. It's a very rich zone, and never really has it been exploited as much, in a good way, exploited as much as it is at the moment. And so there have been waves of investment that have come in. China has been a huge investor in Sub-Saharan Africa. What do we see happening at the moment? Well, we see infrastructure, whether it's physical infrastructure or financial infrastructure, still in a state where it's building. It needs a strong commodity sector to sort of fund what it is that's going on there. So the implications on public finances of the drop in commodity prices are causing some short-term difficulties. Our view is that if we actually have a world that is growing as opposed to a world that is going in the opposite direction, then there still is demand for these commodities. And so throughput is still actually increasing, partly as a result of demand, partly as a result of the investments that were going in the years prior to the price plunge. So the throughput is actually increasing. What we're talking about is money and profit flows. Well, we've already seen a partial recovery in commodity prices that has commodity producers around the world breathing a little bit easier. Now, those prices have a long way to go to get to where they were before, but it's amazing what happens in an environment like this. Commodity producers get very creative. Let's remember that right across the world and in Sub-Saharan Africa, companies were paying top dollar for people, for materials, for equipment, And there's a lot of pencil sharpening going on at the moment that's actually making many projects much more viable than everybody thought they would be at today's prices. So we're in a period right now where it seems like the wheels are all falling off, but that's because it's the renegotiation period. Companies are getting their suppliers around the table and they're saying, well, look, we just can't operate, so we're canceling all of our projects. That creates the panic that gets everybody around the table. A new deal gets carved out, and we always come out the other end with a more positive story than it looks at the moment. So that's what we believe for the sub-Saharan Africa space. So there are negative stories to tell. South Africa is not having a very good time at the moment, but it has a very well organized banking sector. And so we believe that the fundamentals being in place the way they are, the superstructure is there to accommodate the growth when the time is right. And we believe that that will be in the near-term period. So we're not taking our eyes off of the deals that are happening inside of Africa. We're not turning our backs to the market. We, like everybody else, are sharpening our pencils, but we're still seeing a lot of opportunity in the long run inside of that space.
Okay, so potential in Africa. That's good to know. We're just to let everyone know, we're getting a lot of questions about India, and EDC actually has 2 great webinars on our YouTube channel that are specific to India. So this is something you can check out after the webcast as well. We'll try to get a little bit more on that market in a minute from Peter.
Sure.
But before that, I actually want to go to another nation that's often associated with the BRICS, the BRICMs, and that's Mexico. Can you tell us a little bit about your forecast for Mexico, and if you see that as a growth story or a potential good option for Canadians?
No, I'm glad for the opportunity to talk about Mexico, actually, because some very exciting things happening in that market. You know, Mexico shares a key benefit that Canada has, and that is, you know, we share a border with the United States just like they do. And so what this has actually done is to more closely link Mexico to the good news story in America. So the flows of goods and services are strong. Mexico has a very a vibrant auto sector like we do. There's been a lot of investment that has made its way there. American auto sales are rocketing up at the moment. They're at very, very high levels. And so Mexico is capitalizing on those flows as well. Mexico continues to attract investment from other countries, ourselves included. Now, you know, what's driving this investment? Well, it's not just the auto sector. There are quite a few sectors that are bringing this investment in. And I think that whereas we always focus on what we might be losing, I think we should look across the Pacific and ask the question, what's China losing throughout all of this? Because, you know, it wasn't back very far in 2001 when it was 11 times more expensive on an hourly basis to hire a Mexican worker versus a Chinese worker. You know, over that period of time, it's almost even Steven. So the business case for actually investing in Mexico has improved vastly over that period of time. You know, it's not really so much about what Mexico has done. It's more that, you know, China has been running out of labor and its wage costs have been going up. So, you know, people are looking at the Mexican market and saying, wow, you know, not only has the cost structure gone through a revolution over the last little while, but we actually gain access to NAFTA and also to the Latin American space by being there. And so many investment choices actually going into the Mexican marketplace. You know, true, they struggle with security issues and so forth, but that hasn't stemmed the flow of investment going there. So in spite of what oil is doing to their economy, their producing economy as well, Mexico is actually sporting some pretty good numbers.
Okay, so that's Mexico is also a good news story.
It is a good news story.
That's really good. I also wanted to mention that, because we have a lot of questions coming in about different markets, but I want to get into a few more specifics. If you have any questions about markets that we can't cover, you can go to edc.ca and check out our market knowledge for in-depth questions. You can also reach out to any of our representatives. We have offices all over the world. So please reach out to them, and they're happy to answer your questions. Might be delayed depending on time zones, but they're there to help you. My next question, I actually wanted to get very specific, And we've had a few questions about agriculture and commodities. We've had a few questions about Asia, and a number of them together. Do you have a forecast on agriculture commodities like pulses and how those will do in the Asian markets?
Well, you know, I've got a protest here because every question you're asking me has a very positive answer, and I'm really sort of worried about people thinking that I'm this irrepressible optimist out there.
Aren't you though?
Well, there are no. I'm a realist. I'm a realist. So you know, please don't think of things that way. There are, you know, the negative stories to tell, but boy, this one is one that is an extremely positive story, and for a long period of time. And where it starts, really, we believe, is the emerging market middle class. Many don't know it, but this middle class is a new emerging army inside of the world, an army of consumers. And you know, let's just try a couple of numbers out on you. The best numbers that we have on China indicate that the middle class there is growing by Canadian population every year. And you know, that's just something that knocks you off your feet. Now, why is it that we focus on this particular cohort? Well, as they're getting more wealthy and graduating into the middle class, studies show that they consume more and they consume higher quality. No great revelation, but they also start with food. You know, and one of the things that they do in general is eat more meat. Now, what that does is radical for the world food supply, because it's well known in agricultural circles that when you start consuming more meat, well, it takes 7 to 10 times the amount of grain to get the equivalent caloric intake out of meat as from just consuming those grains themselves. And so all of a sudden you have this exponential pressure on the world's grains. Now, it's not just the world's grains, that extends as pressure to everything in the agri-food continuum. And so, you know, do we see any evidence of this? Well, if you go to the Chinese market, and what we'll do is we'll turn the microscope over to a particular part of Canada. Let's go to Nova Scotia, which has a very vibrant fishing industry. Well, just sending raw fish products over to Asia wasn't even a business. It wasn't an export business in Nova Scotia back at that time, or I should say specifically to China. There was nothing happening. It's now a $100 million business. If you look at prepared seafood products, it was a $40 million business back then. It went through tough times in the global recession. It's now over a $100 million business. When you look at exports specifically of lobster to the Chinese market, they are growing at an exponential pace that makes your head spin. Now, why do I talk about that? I believe that's the leading edge of what can and will happen right across the agri-food spectrum. And we here in Canada happen to be net producers of food. We are a breadbasket nation for the rest of the world. So whether we're talking about grains or oilseeds or special crops or meats or the whole range of processed foods that we are doing or can do, or whether we're talking about fertilizer, which we ship to the rest of the world, agricultural technology, which we're very good at, or machinery and equipment in the agricultural sector, all of these get influenced by a world that is getting hungrier and less able to feed itself because of the supply of arable land. So, you know, I'm sorry, Carolyn, but you served me up with a question there that just has a lot of white space in front of it. And if there is a sector that I am very, very bullish about, not just in the short term, but over the long term as well, it would have to be the agri-food sector.
Well, that's great. Now, Peter, with that in mind, I have another question for you, and I wish I could take credit for it because it's a very good question. But then tell us, talked very positive, what's keeping you up at night?
Well, thank you for the opportunity to talk about that. I didn't know that that was coming, but look, when we have a situation at the moment where real activity is actually booming in a lot of cases, and again, that's not just what we're seeing in the data. That's what we're hearing from businesses outside of the energy and mining sector right across Canada. They're telling us that this is the case. When we see that, but when that gets underplay around the world, when media messages and anecdotal stories actually convince the broader population that this is a world that is very turbulent, that isn't performing properly and so forth. When those very strong pockets of growth do not get that airtime, then what comes up in the middle of those two issues is this thing called sentiment. And there are three S's to remember when it comes to sentiment or confidence inside of the economy. One is sentiment sells. That's why it gets a lot of airtime. That causes sentiment to spread. But the worst thing about this particular dynamic is that when we all become convinced that things are gloomy out there, even if they're not, and I'm arguing very strongly that the fundamentals suggest that they're not, the third S is that this can become self-fulfilling. So what keeps me up at night is, what's the event that's going to come along that's really going to turn our sentiment over to the other side and undermine this story? Well, I can't really imagine what the end game is for that, because it's not feeling pretty good for me. But, you know, it would be a shame if sentiment actually was a thing that was the game wrecker here, because as we look at the fundamentals, the things that always drive growth, they are pointing almost singularly in the positive direction. And all this economist wants, and you know, those who are looking at things the same way, is for the world and Canadian exporters to be able to leverage those fundamentals as much as possible.
Well, Peter, unfortunately, that brings our time to a close. So first, thanks to our audience for some really good questions. I'm really sorry we couldn't get to all of them, but you were all so engaged. Thank you, Peter, for a very engaging discussion. It's always a pleasure. We hope we have given you a better understanding of the global trade environment, and hopefully this has also helped give you insight for your future exporting needs. For those of you that want to revisit a few things Peter has said, EDC will be sending you an email with a link to the discussion. You can also read the entire global export forecast by downloading it from the webinar interface. Just click on the content button on the lower left-hand side of your screen to begin your download. You can also visit the Knowledge Center on our website, and don't forget to catch Peter in his weekly commentary every Thursday. If you have any more questions about helping your business export, please don't hesitate to contact us by calling 1-800-229-0575 or emailing info@edc.ca. Thank you again for joining us today, and have a great day in trade.